Hi, everybody. You're starting to jump in to the Women's Affordable Housing Network's third of three on the bond series. We have a record number of people signed up. I have to think it's not only the topic, but the amazing presenters we have today. So thanks for joining us. We've learned at WAHN that about 3 minutes after a presentation is when most of the people that are coming are going to be in. So I'll just keep talking until then. So if you hear me on repeat, I apologize. Um, we do have the WAHN Summit registration open with some already very dynamic speakers signed up. That's May 3rd through 6th of 2026. Sunday is a community service and property tours day, and we're going to get a really cool flavor of San Diego. We'll be supporting some women-owned food vendors. We will be hopefully seeing a homeless circus called the Fern Street Circus. So a really fun day on Sunday, followed by 2 days of technical programming and professional development. And the third day of Wednesday will be leadership meetings and training. So check that out. That's on the website now, and we put it in the chat. Also, we have an upcoming AI training for free, October 9th at noon. I like to tell everyone, if you need someone who's calm and will calm you down about what's coming AI, this is a great teacher. Ann Hollander is amazing. I am not a tech person, but she's got me fully embracing AI and what's coming at us. So check that out October 9th. And look, I got us here to the 3 minute after. So I'm going to hand that over to Allison King. And thank you guys again for joining us today.
Thank you so much, Ashley. Really excited to be here and so excited for the great turnout today. I'm Allison King. I'm a partner with Tiber Hudson Law Firm. And as Ashley mentioned, I've been sort of working on the three-part series relating to bonds this year. This is our third in the series, so advanced topic, and a really timely presentation on the new 25% test. We're going to talk a little bit about recycled bonds, as well as what's happening in the market with bond pricing, equity pricing, and all of that that's going to set you up for success into the next year. So I'm going to start off by introducing the panelists, or letting the panelists introduce themselves. I'll pass it over to Kent Newman, who's to my right on the screen.
Thank you, Allison. I'm also a partner with Allison at Tiber Hudson. We specialize, as folks know, in doing 4% bond deals around the country, closing on average around 350 transactions in pretty much every state in the country, including DC, and working on some in Puerto Rico and US Virgin Islands. With that, I'll hand it over to Britton Henning.
Let me get off mute. Yeah, thank you, Kat. Good morning, everyone. As mentioned, I'm Britton Hennig. I'm with Stifel. Our team at Stifel, we've got a dedicated team across the country. We serve as bond underwriter on primarily 4% low-income housing tax credit transactions. We have done and been the leader in this space for the last 15 years plus. We do more of these publicly offered bond deals than anyone in the country. We've been very fortunate to work with everyone on this panel. Certainly appreciate the opportunity to be here today and look forward to digging in a little bit. Allison, I'll give it back to you.
Yeah, Julie, do you want to go next?
Yeah, my name is Julie Lawrence, and I'm a principal with Novogradac based in Tampa, Florida. And I specialize in LIHTC deals, doing audit and tax work and consulting work. And I also work on HUD and USDA finance deals and investor and syndicator work too. So back to you.
All right, Kat.
Last but not Thanks. Yeah, my name is Kat Vielm. I'm a director of acquisitions at Redstone Equity Partners. Here at Redstone, we've raised over $12 billion of equity over the last 17 years, and we have roughly 70,000 homes that have been financed through the low-income housing tax credit under our asset management currently. We're in 48 states. I'm currently working on 49, which is South Dakota, looking for 50th, which is North Dakota. So if you have a deal there, I'm only half kidding. You should message me. Roughly, I would say 40% of our deals are bond deals. So really interested to both share with you guys what we're seeing and also to learn too. So yeah, looking forward to talking with everyone.
So I believe this is being recorded and slides will be available to registrants after the presentation. But if you do have questions throughout the presentation, feel free to pop those into chat and we'll try to monitor those throughout the presentation or save them for the end. But yeah, let's go ahead and get started. All right. We don't often get a lot of exciting changes and news in the bond world. So the 25% test is really, a very exciting change. So I think Kent and Julie are gonna maybe kick us off in discussion.
Julie, you want to give us started, or I can jump in?
Oh, yeah, I can jump in. So the 50% test, 25% test, is, we call it the finance buy test. So, to qualify for the 4% credits, the project must utilize the private activity bonds greater than 25%. So if the deal is closing on or after January 1st, 2026, or 50% if the deal is closing, in 2025 still. And that is 25% or 50% of aggregate basis. And aggregate basis is eligible basis plus land. So here you can see, we've got our eligible basis, we've got our land, and the total there is the aggregate basis. And then just how much, the biggest difference with the 25% test and the 50% test. So in this example, we've got 20 million in aggregate basis. So the borrower is going to request greater than 5 million in tax exempt bonds if closing next year, or 10 million if closing this year. And I have a couple of other examples of this later too.
Yeah, this is the actual language. We won't bore you with reading the specifics, but as Julie mentioned, and Allison mentioned, this is the biggest change we've seen in the industry for several decades. It'll have pretty important and meaningful impacts to the industry going forward. So we're going to attempt to cover how it works and some of those implications. Obviously, we'll be projecting kind of what things look like and giving our recommendations, at least from Tiber's perspective, on how developers should move forward in this new landscape. A couple of quick things to note: make sure you're looking at the final regulations. They were a few different iterations. This is permanent, which is good news. So there's no phasing out of this going forward. And it does apply, as folks mentioned, if you're already placed in service, this or will be this year, the 25% test will not generally apply. We'll talk about how there can be situations by getting more bonds next year. If you're running short on your 50% test, you may unintentionally or intentionally try to trigger the 25% test. But and then also at the very bottom, not highlighted, and Julie certainly can provide some additional details on this, but for acquisition rehab transactions, there are situations where the buildings might be acquired this year, for example, by the partnership, but not actually financed and no bonds issued until next year. And that language was at the very bottom in B, is intended to clarify that the placed in service date for that purpose would be for when the rehab is completed with the bonds. So you don't have to be concerned that there's any gray areas that if you acquired the building 1 year and then use bonds in 2026 or later, you should still be applicable. The 25% test would still be applicable. So. All right.
All right.
Oh, yeah,
Go ahead.
Allison. Oh yeah, no, I was just going to say, so here's some of the things I think that Julie and we have been kind of focusing on in the new environment. Julie, you want to kind of want to cover any of these, or we can jump in as well?
Yeah, I mean, I kind of have examples of a lot of these as I go along, so it might be easier if we just kind of,
Great.
Maybe go to the next slide, and then we can talk about these in more detail by each kind of individual one. Okay, so these next couple of slides here, I think, provide a good visual on what lowering the 50% test to 25% can mean for a deal. So on this slide, you can see the timeline of construction from acquisition to conversion, and then you have the financing shown along the right side. So our example shows that we have 9 million in short-term bonds, which will be taken out by the equity at conversion. And we have 9 million in long-term bonds, so a total of 18 million in bonds. And in this scenario, we are meeting the 50% test. And I think roughly at 55%, with the numerator being the bonds of 18 million and the denominator being the aggregate basis of 33 million. Okay, so next slide. So on this slide, we show the bonds having to meet the 25% test. And you can see now that we still have our 9 million of long-term bonds, but we no longer need the short-term bonds to pass the finance by test. However, we still need to fill that financing gap. So that could mean getting, the equity earlier in the deal, or that you replace those tax exempt bonds with recycled bonds, which I know, we'll talk about later, or other taxable debt. And I also just want to point out that because we are no longer using those 9 million in short-term bonds, it frees up those bonds for another deal, which is what we're all really excited about. So much more housing will be created because of this new legislation.
And this is a good slide to go back, Allison, real quick. Those I like the squiggly line through there. Those $9 million of bonds, and those have been used in for transactions across the country, especially new construction deals. Most transactions, in our estimate, can support anywhere from 30 to even 45% of aggregate basis, but very few, especially new construction deals, can support enough debt to go all the way up to 50% of aggregate basis. So almost all the transactions folks have worked on in the 4% space had this B piece that was needed. So as Julie mentioned, those will not only be able to both be redeployed back into the system for new transactions, but it is the actual, and just to kind of tee this up for our future conversation on recycled bonds, this is where recycled bonds are coming from for the most part, is that these short-term B bonds that were issued over the last 4 years, we'll talk about why 4 years is important. If they are being scheduled for redemption within 4 years, they are eligible to be redeployed one time to another multifamily deal. They do not come with tax credit, so they will not apply to your 50% or 25% test, but that's the source of them. So there is this interesting phenomenon that we're going to see over the next 4 years, is that not only would we be able to tap into these extra volume cap bonds for new money bond allocation for transactions, we also, if issuers and developers are really on top of things, they can tap into what could be a significant portion of recycled bonds. But that recycled bond pool is effectively going to be diminishing because there won't be any B bonds, for the most part, needed in the current environment starting January 1. So just something to keep an eye on. Could be an opportunity to get your deal done in a more efficient manner, but just something to highlight there is where these B bonds, what they were doing and where they will be used or not used in the future.
Yeah, that's a good point. Okay, so this last slide here just shows the financing gap filled up nicely and passing the 25% roughly at 27%. So that's all buttoned up nicely. So do you want to go to the next slide? Okay, so now let's walk through a couple of examples of how this might look satisfying the 25% test during the transition period. So for projects that have already issued bonds, these projects will need a new issuance of bonds in 2026, and the new issuance would need to be 5% of aggregate basis. So let's say you have a total aggregate basis of 100 million, which was originally budgeted to be 80 million. And we're over budget due to cost overruns or other construction issues. So in 2025, you received an allocation of 41 million in bonds, And then in 2026, you received a supplemental allocation of 5 million in bonds. And I know there's a typo on this graphic here because you probably wouldn't have the budgeted 2026 issue, but but that doesn't affect our calculation. So so you have total bonds of 46 million. And as you can see, we're currently failing the 50% financed by test at 46%. So however, with the 2026 issue, that's 5% of aggregate basis. So you're good and subject to the 25% test. So if that 2026 issue was less than 5%, you'd still be subject to the 50% test.
I think it's consistent with how we've been approaching this. Basically, if you are missing your 50% test for deals you've already started working on by less than 5%, then you would want to go in with obviously with some cushion to just get above that 50% test. If you miss your mark, unfortunately, by more than 5% of aggregate basis, then you can back into the 25% test. You end up being well above 25%, which is interesting, but not asking for, and maybe not incurring as much cost as if you had to go and go up to the 50% test.
Right.
One other thing I'll mention on this that I think we've been doing a lot of advertisement on it is if you do some of these cash collateralized structures that Britton and we and Stifel work on a lot with folks, there is a benefit to going in. These cash collateralized structures do allow in many cases to provide some cushion on your 50 or 25% test. And that is to say that any bond proceeds, those earnings before they're deployed to the project, the earnings count in the numerator for the 50 or 25% test. So that means that if you're very, very close on your 50% test, before you have to go and ask for more volume cap, or potentially, as Kat knows, we probably have to cut developer fee, which would be catastrophic in some cases, to get to that threshold to meet the credit requirements. There could be, and we have found, luckily, some opportunities where those earnings have been just enough to squeak over the test and let deals move forward without incurring what could be quite a bit of extra cost. So just something to keep an eye out for, those cash flows. And this is true going forward. The earnings on what might be an equal or lesser amount of bonds still count in the numerator. So you do get that added benefit on using those cash collateral structures that we'll chat about.
Yeah, and you also have to make sure you could get the supplemental bonds if you
Good point. Yep. Right.
if you're in that situation.
Hard, yeah.
Okay, so next example 2. So we have the same aggregate basis of 100 million, and you think, yay, I'm passing the 25% test with that 2025 issue alone. However, you aren't, because that bond issue was in 2025, and you're still required to pass the 50% test in 2025. However, you will pass the 25% test in 2026 because of that supplemental issue, since the 2026 bonds are 5% of aggregate basis. So you would still be okay in this example. And you'd still want to have a cushion, just like you would with the 50% test, but we're using some round numbers here, so this is just very simplified. But I think in this example also shows how a state could decide to finance a lower percentage of a deal in 2025, say 20 to 25% this year, and then next year commit to financing another 5 to 10%, so it meets the 5% in 2026 and passes the 25% test overall.
Yeah, Kat, I'm curious if you have your investors, I guess, or have gotten comfortable with that idea or concepts. And secondly, I'll tell you real quick is if you do, we're already pretty late in the year for folks to start doing this now, so I wouldn't necessarily advocate for this. But if you are going down this path, the amount you issue in 2025 is almost irrelevant in the grand scheme of things, as long as you meet obviously over the cushion and as much as possible you want in 2026. Because if you miss the 5% threshold by even $1, you failed the test, right? So you technically at closing, you wouldn't meet either test. So you really just want to make sure that if you had any side to pick on where you wanted cushion, you want it on the 2026 issuance. So Kat, what are your thoughts?
Yeah, I mean, I would say, so a couple things. First, the law change happened July 4th, 5th, right? So middle of the year is always tough, especially as most bond deals across the country tend to have a year-end closing date that must be met. Again, most, I know it's very, very broad. And so it has been a bit of a challenge to roll through this in the underwriting process. I think what we've seen is a couple of states come forward with guidance for 26 and how they're going to make it not this cliff, not the 50 to 20, 25 test, but instead doing, say, a greater of 30% or the first mortgage amount to make sure that that first mortgage is benefiting from tax exempt debt, right? So it's as cheap as possible so that we can leverage as much debt as possible, so less, state, county, city funds are needed. I have seen less state guidance on the kind of mixture of 50 and 25% test, which I believe was part of this slide and also the last one too that I didn't chime in on. And I think that's going to be a little messier. So I think generally we've seen state by state. I know Illinois issued guidance just this last week. TCAC issued guidance maybe in August. I think they were maybe the first. So it's been a bit of a challenge. I don't think we've seen any hiccups so far. On the equity side, our investors really just want to make sure that the test is being met, right? And to your point, Ken, it is a cliff. So whether your state says it's 25 or 30% test, whether you're blending, we want to make sure there's cushion there because it is a cliff. You missed it by a buck, you might as well have missed it by the entire amount.
Yeah, and I will say the good news is I think the federal rules, we spent a fair amount of time, a few groups working on them to avoid any questions. So there's no real question on whether it would qualify on the federal level. But I do agree that only certain states are even going to consider the lower threshold this year, and then as supplemental last year. Some of the maybe bigger players like New York and a few others, maybe California. But I think most issuers, to your point, that we've talked to, and deals are moving forward with the 50%, calculations, with the expectation also that we've been advocating for, and we'll do so on this panel, of how issuers should be allocating into next year, which we'll talk about shortly.
Yeah, well, I know that NCSHA has a page on their website which kind of goes through states and guidance that they've already put out, or anticipated guidance of when that might come out. So that's a good resource too. I can throw that link in the chat too in a little bit. A couple other things I wanted to point out related to the finance buy test just quickly. So the finance buy test, either the 50% or 25%, has to be met by the end of the first year of the credit period, unless you have a multi-building, multi-place and service development, which you'll need to monitor that test during construction. And also, and Kat referred to this, if your project does not satisfy either test, you're only going to receive credits on the percentage financed by the bonds. So that's really hard to get past as a deal if you don't meet the test. So, if you only are at 49% at the end of the day, you're only going to get, 49%. So it's hard to replace that equity. I mean, that's really the question. You just can't really get past that. Okay, next slide. I guess we're there. So I'll quickly go through some of Novogradec's estimates on the increases expected based on two of the provisions that were included in the tax reconciliation bill. So the lowering of the 50% test, which we've been discussing, and the 12% increase in 9% allocations, which was also a big win for affordable housing in the bill. So combining both of these provisions, we're expecting to see over 1.2 million new rental homes over the next 10 years. So that's really exciting. Okay, next one. Okay, so this is a volume cap scarcity map, which, I'd like to thank Tiber Hudson, because Novogradec and Tiber Hudson work collaboratively on this map. So it really shows the states that are currently oversubscribed, at parity, or undersubscribed. And I think that for oversubscribed states that we've been talking about, the lowering of the 50% test to 25% test will definitely free up some of that volume cap to get more developments funded. And talking about different states, I think of California, for example. I know Mark Shelburne and Mike Novogradac were talking about this on the Tax Credit Tuesday podcast this last week. So California created an incentive for developers to reduce their volume cap requests. And so you could get more developer fee or potentially be more competitive on future applications. And the developers are really responding to that. They mentioned that an estimated amount of bonds returned was approximately 600 million. And those bonds could end up being issued next year. And that could potentially mean 2 billion in overall land and building costs. So that's pretty huge. And other states could similarly carry their bond authority forward to next year and issue those bonds next year. So it would be the lower 25% or commit to financing a certain percentage this year and next year, which I talked about in my last example. So that's just a couple of different options for state agencies that they might consider, when and how to implement this new test. So
yeah, I think it's really important to, as Kat mentioned and Julie mentioned, just the states have the autonomy to implement this on their own. So it's not a nationwide sort of implementation of this 25% test. So, Texas, for example, is one that's sort of standing by the 50% test. And so just understanding your market and understanding like these different jurisdictions and how they're, what their positions are is going to be very helpful moving into next year.
Yeah, and what we're advocating for and think will be still plenty of volume gap to go around, especially given if you go back one slide, going back to this slide here, we wouldn't expect the parity or undersubscribed states to now be more competitive in the new environment. So those will probably stay either at those levels or have enough volume cap to cater to the transactions that are moving forward. It's really focusing on the oversubscribed states. And in our assessment, as Julie's earlier slide pointed out, since there won't be the need for as many of these B bonds or 50% bonds or gap bonds, as folks call them, going forward, that would free up around a third of all the volume cap annually that's been issued in the last several years to be redeployed into new deals, which is great. That's a third increase by itself. And then separately, as I mentioned, if folks are able to tap into recycled bonds, which we think is definitely achievable, that could free up an additional roughly third of volume cap. So you're now talking about $14 to $16 billion nationwide annually per year of basically another additional tax-exempt debt. So especially now also given the other constraints that we'll talk about with equity pricing and just normal constraints from a capacity perspective, we think issuers should start off by allowing transactions to go with the greater of 30% of aggregate basis or permanent supportable debt. So if a deal supports 35% or 40% even, we would recommend you go in for that level. If the issuer or the developer, for that matter, can state that they're willing to take recycled bonds for any amount above 30% of aggregate basis, that should also be in the QAPs if any of the allocating authorities are listening. That would be a really beneficial outcome, letting deals not have to absorb more expensive taxable debt and using the tax exemption as efficiently as possible, maximizing the amounts deployed to affordable housing.
And I think the other thing I'll add here, just briefly, I know we'll touch more specifics later, but this is a lot of good news, right? We're going to create a lot more homes for people who are in desperate need. Just last week, I heard of a property that had 46 units of housing opened up a couple of weeks ago. They had over 1,000 people put their name on list. So the need has never been higher. At the same time, we're dealing with state and city budgets across the country that are getting smaller and having serious issues. Denver, as an example, had to recently close, I think, libraries, and also lost a lot of city jobs. So the environment locally for key public sector issues is now getting harder. It is going to be even harder for us to ask for more subordinate funds from these counties and cities and states that are going through budget crises. So even as we know there'll be more homes from this, keep in mind that most developments in most of the country, and I'm speaking super broadly because it's different everywhere, requires some soft funds to get done. It's not just credits plus the first mortgage and some additional fee. So just keep that in mind as you're thinking about the opportunities and structuring and what else we can do to get deals across the finish line, because your agencies, your states, your governors are going to be working with a lot less in the next couple of years.
Yeah, I think too, just making sure you have a little additional padding in your budgets as well. Issuer fees are based on the bond par amount. So are they going to be able to still close the same deal for half the fee? I'm not sure if they'll be sort of rearranging fee structures and things moving into next year. So something to kind of, create a little bit of contingency in your numbers for. There are some questions in that. So there was one about how to access recycle bonds, which we're going to be talking about here shortly. And then one question was, how does being in a parity state versus an oversubscribed state affect a developer's ability to access bond financing for affordable housing?
Yeah, I think the latter, again, I think at least our expectation, curious, Julie, if you guys have done some analysis, I do think pretty quickly the orange states will slowly maybe move to parity is our expectation if they, do things in a deliberate manner. So I do think it's still important to know within your jurisdiction that you're working in, understanding the timing of the award cycles. Some are just rolling, some are prescribed, having that timing down and what that looks like, and every state's going to be different for the most part. That's going to be really important, but I do think there's going to be higher probability of obtaining volume cap going into next year with these new rules. Again, at a minimum, we would expect a third more volume cap and potentially even more with recycle bonds. So, but as Allison mentioned, we'll talk about recycle bonds shortly, but that's our take on how we think this map will change. It's not in real time. We, as Julie mentioned, we worked with Novogradac for several years, and this is a little bit of a art, not a science. It's not like there's no nationwide database, unfortunately, to say how much in bonds each state's allocating to multifamily or how much they're using it. So it does take a little bit of time to gather the information, but based on the feedback we're hearing from different states that are mostly orange, we do think we'll get slowly start seeing those go into parity, but I'd say it probably will take a little, maybe middle to later next year to really start reflecting it on these types of maps.
Yeah, and it's not going to instantaneously double the amount of deals that are going to be done. So certainly we'll improve the numbers, but not double.
Yeah, and I think the other thing, I'll just chime in real briefly. You can keep this next slide too. While it will not double the amount of deals, one of the things we've been telling our clients to be thoughtful of as they're pitching deals to us is we're looking at a lot more deals in places like Texas, in Florida, in Georgia, where they don't need as much soft funds to get that bond deal done, right? So if I'm looking at, deals in Oregon or Michigan versus California and others, keep in mind that our volume as an equity player, we're looking at a lot more deals. So you're not only having to think about how does my deal look based against my next door developer that I've worked against and bid on different sites on, right? You're competing actually now against a much larger national pool because there's just a lot more deals on the marketplace today. And on average, those deals are much larger. When I started working in this business about 15 years ago, our average deal was maybe $10 million in terms of equity. Now it's closer to like 25 million. And so the checks are getting larger, the underwriting's getting harder, the questions that we're asking are getting lengthier. So something to keep in mind as we're thinking about these next round of bigger, stronger deals for us to build additional homes is what can you do to present it in a way that works, not just for bond counsel, who's really crucial, and not just for tax counsel, but to make your deal shine over the next 20% additional deals that we're going to start to see across the entire country.
Yeah, there's so much uncertainty with soft funds now. And so just sort of the theme of doing sort of a naked bond deal, if you will, it's just bonds, just equity without all of these soft funds, is definitely a preferred approach. And I think that there are a lot of creative bond structures that Kent and Britton are going to talk about that can create those savings and create those benefits financially for the deal that actually will save you a lot of legwork on sort of running around and cobble together a bunch of, $100,000 grants here and there, which, are important, but also a little bit unpredictable.
Right.
Okay, so the next couple of slides, I'm just going to quickly discuss the 266 election, which is really about capitalizing interest and more specifically interest related to bond deals. And as a caveat here, there's a lot to this election and we don't have much time, so I'm just going to quickly go over a couple of things. Okay, so I know there's a lot of words on this page and you can read that in its entirety, but basically Internal Revenue Code section 266 refers to a specific provision in the code that allows the taxpayer to capitalize certain carrying costs rather than deducting them in the current year. So 266 is the alternate election. You have to elect into it, with the general rule being section 263A. So why are we talking about 266 today? I mean, well, I think for the context of this webinar, and 266 generally relates to bond deals, as I mentioned before. Plus, we've had some changes in the interest rate environment and an increase in the use of cashback collateral loan structures. And we also now have the 4% floor, and now we have the 25% test. So the question of this election could come up a lot more frequently. So we wanted to just kind of touch on it. So next slide. So I think the biggest difference in our world related to sections 266 versus 263A is timing. So 263A says you start capitalizing when the production period begins and you end when the production period is over. So that's your window. It is also a building by building calculation. And we also have the amount of debt. So 263A, generally speaking, says the interest on debt used to finance production expenditures can be capitalized. So for example, if the bonds were issued all up front and were put in a bank account and are financed by debt with either bonds or some other loan, you have interest being incurred on that debt, and you're probably not going to be able to capitalize that interest. So this is where 266 comes into play. So the timing changes, first of all. Here we have the production period interest that can be capitalized, and you can potentially keep capitalizing that interest until the very last building is completed. So when you look at the regs, it refers to with respect to the property. So with respect to is not defined in the regs, so that's up to interpretation. But as an example, if you have a cashback bond deal where you have the bonds and the replacement debt, you need to ask yourself, is the replacement debt incurred with respect to that property? So basically, do you have two financing activities or just one? So I think there are a couple of things you can look at to answer that. So the bond agreements, do they require the bonds to be issued all up front? Are the rates and terms impacted by the cashback feature? And really the timing of when the perm loan proceeds are funded. So also with specific structures like an rehab deal with acquisition debt or a cash collateralized deal, or even if the bonds are issued all up front, So to the extent you can include all of that in eligible basis, it could be a significant amount of interest that you're capitalizing. Okay, next slide.
The only thing I'll add there is that is basically just free equity, right? So you want to make sure that your bond counsel and your equity provider are aligned, but I have yet to work with an upper tier partner, a banking partner that's not comfortable with making the 266 election. So it can be a huge help, especially since we're seeing additional taxable debt, right? So that interest expense is going to be larger. So if we can put, as much of that interest expense in basis and get y'all credits and get you equity for roughly 30-ish cents on that dollar, then that's 30-ish cents you don't have to find somewhere else.
And yeah, and real quick, if it's in a basis boost area, if you're getting a state tax credit, and I will say one last thing, 266 is not a bond test, so don't ask, actually, no disrespect, Kat, but don't ask your bond counsel because they won't care. You don't need to get approval on that. Ask your accountants and your equity and make sure they are all early and often on the same page. There is some, and you may be talking about this in a minute, Julie, there is some income you have to make sure everyone's factoring in. There's actually some new, really fun, I'll say, techniques we've been working on with Novogradac on how to try to minimize the impact of that income. But that's also something to raise frequently. And I know Britton at Stifel, you guys do a ton of these cashback deals. I know a lot of your developers seem to really be, I'll say, maximizing the benefits in the current marketplace with that structure.
Yeah, absolutely, Kent. To your point, and Kat, we appreciate it when someone says creates free equity. Especially the equity provider. But absolutely, I think the last couple of years, we'll touch on it here in a minute when we start looking at some interest rate stuff and kind of showing where this differential comes from. But certainly a great way over the last several years to kind of fill some gaps, if you will, on some of the financing side.
Yeah, can you go back to that last slide, Allison? So couple final things here. So how long should you capitalize interest? Do you get to capitalize building by building, or can you go through the very last building if you're making the election? I think the regs say the election is effective until the development or construction work has been completed. And I mean, looking at the IRS audit technique guide, that does suggest that you can keep capitalizing under 266 until the last building is placed in service. So I think my last point on this slide is really the most important. Don't flip flop. Try to be consistent. So don't say on one deal you're going to capitalize until the last building is completed and the next year you're going to stop sooner and go building by building. So just aim for consistency across your portfolio. So that's a recommendation there. Okay, a couple final things on this. There are some gray areas here. So there are a couple of things in the regs that are not spelled out. We already discussed with respect to term. So, and to be considered materially distorted just basically means the amount must be material and the effect must be distorted. But this is when it gets really important to talk to your CPA and how these terms can impact your decision on the election with respect to your specific deal. So please reach out if you need guidance on making this election, because facts matter, especially if you have a deal. If you have questions on a specific deal, every deal is different. And we really need to take a look at the facts and circumstances. So it's hard to make just a blanket recommendation here, but reach out definitely if you have questions. So it's also really important to read your partnership agreement, which may spell out whether or not to make this election, and to verify with the investors, like it's been said, before you make the election. So really just making sure everyone's on the same page here. So, and then there is that potential for taxable income during construction, but I'm not going to go into that too much. I just really wanted to touch high level on everything. So I think that's all I have. So I can pass it on.
All right, Britton.
Thank you. Yeah, I think we're going to go through a little bit of what's happening in the market and then how that impacts some of the structures going forward. So,
Sure.
take it away, Britton.
Yeah, absolutely. again, everyone always wants to talk interest rates, right? So this slide's a little busy, but we've got kind of a snapshot, if you will, over the last 3 years comparing the U.S. Treasury. The U.S. 10-year Treasury oftentimes is the index used to price your long-term debt. So if we think some private placement products, we think about our Freddie Mac TEL, so on and so forth. Oftentimes they're priced off of that 10-year Treasury and a spread to that. The 10-year MMD stands for municipal market data. It's the most commonly used tax-exempt bond index in the country. And so at Stifel, when we're out there pricing these bonds, we oftentimes look at and price off of MMD compared to the Treasury. Treasury on the taxable side, MMD on tax exempt. So as you can see, the 10-year historical, the past 3 years, the averages between, obviously we've had at times pretty significant differential between the two. You'll look here, I think sometime around April, Liberation Day, is when we saw a very significant shift in the market. We've begun to see that come down just a little bit, but again, over the last 3 years in particular, we've continued to kind of enjoy a pretty decent little spread between the two, as you might expect. In a normal market, differential on tax exempt and taxable, certainly there should be some difference there. Depends on how significant year in, year out. This slide, again, we're now moving from 10-year all the way back to 1 to 30. The interesting thing about this one is if you look at the 1-year differential, so MMD around 2.12 and our 1-year Treasury around 3.61, obviously our gap begins to shrink the longer out we go. And so what we've seen and what's been kind of our challenge over the last, call it 6 months, is MMD's been a little stubborn on the long end. And so we've kind of been hanging out up there at a little bit higher rate. When we started pricing things primarily off of MMD, we did so because the volatility in that index specifically wasn't as great as what we would see in other indexes. That works in our favor at times, and unfortunately works against us as well. So we've seen the compression on the back end. You'll see there, it's only about 54 basis points difference, whereas on the front end, we're looking at, close to 1.5%, somewhere in there. The important thing to note on the front end, we'll get into some of this on structures. I know Julie touched on kind of the cash back forward, the 266 election, and how that can kind of play into what we're trying to do to create maybe some positive earnings. So if we're doing short-term bonds, we're oftentimes pricing that on that short end. So we may be looking at a 2 or 3 year MMD compared to our Treasury, which is what we'll invest in. And you can see the differential there is far more significant on the short end than what we see there on the back end as well.
Britton, I did get a comment that someone is having trouble hearing you. I can hear you fine, but it might be able to move. I'm not sure if anyone else is having trouble, but
I'll get a little closer.
we're on the edge of our
Bottom
seat.
line.
Yeah.
Short-term rates are low, long-term rates are a little higher.
Next slide.
Let's see. Yeah, and again, this is more indicative of what I just mentioned there. Whereas you see short-term, 2-year short-term yield curve over the last 5 years, obviously coming out of COVID. If you look into 20, rates were on the floor. As we saw beginning in 22, as the Fed began to move interest rates up, MMD Treasury doesn't necessarily run lock stock with our Fed fund rate. However, if one's going up, in all likelihood, they all will go up, right? So they may not move at the same pace, but again, the tone and tenor, if you'll notice, coming out of COVID in 20, when the Fed began to raise rates at the end of the year 21 into 22, we see those rates going up. And here on the back end recently, as the anticipated begin of easing from the Fed, we had a 25 basis point drop last week. All indications are we'll get at least 2, maybe 3 more of those. And so that's where you see the market begin to react and our rates go down on the here recently as well. So you'll notice there in the box, as I mentioned a moment ago, 2-year bond rate around 272. So we're out there selling bonds on a short-term basis with an interest rate of around 2.72. When we do that, we draw down the bonds in their entirety. We park those with a trustee, and we're able to invest that money, presumably either in a like-term treasury or a state and local government security. And right now, the investment rate on that is around 358. So we're borrowing at 272. We're investing that money in at around 358, creating this positive earnings, Kent, you like that, of around 86 basis points. So
Yep.
we've got actual positive earnings here, not negative arbitrage. So that's what's making these cashback forward deals work, is again, creating that differential in terms of our borrowing rate versus our investment rate.
And I know we're running tight on time, so want to make sure folks are answering any questions. We're also happy to jump in after just email Allison any questions as well, and we can jump in after the panel. But we do want to highlight recycle bonds. We think it's going to be the next big thing going into next year with the 25% test, and it leverages what both Julie covered and Britton just covered in terms of interest rate differential. Yep, there you go. Real quick, recycle bonds are, as I alluded to earlier, they are basically just B bonds that were issued on one of your deals or someone else's deal that were only needed to meet the 50% test and are scheduled for redemption within 4 years. That they have to be redeemed within 4 years to be eligible, and they can be redeployed one time to another multifamily deal. And for all other purposes, are just tax-exempt bonds. They get you the tax-exempt rate that Britton mentioned. And can't say this enough, they do not apply in any way to your 50 or 25% test. So if you're going to ask for new money bonds for a 4% deal, again, make sure you ask for at least 30% of aggregate basis. And then for any additional supportable debt, you can use recycle bonds, or you can actually just get more private activity bonds. But obviously the extra amount's not going to help you get more credits. You're just going to get whatever credits you can get. So the most efficient way is for developers to basically pair up new money bonds up to the amount they need, which is 30% of our basis next year, with recycle bonds to get the full capital stack tax exempt. And why is that important? Next slide. There we go. As Britton just nicely shared the interest rate differential, we wanted to kind of give you guys the bottom line here. The interest rates between taxable and tax-exempt bonds, no surprise to folks in this current environment, is anywhere from 50 to 100 basis points difference, depending on the lender and platform you're using. This example is 75 basis point differential. And that 75 basis points, just on this relatively small extra, supportable debt on the deal, is the difference between $600 and $25,000. So that could be meaningful. Certainly more than the cost to put these bond deals together, and certainly could be helpful to the bottom line if you're otherwise deferring some developer fee or otherwise. So this is how deals are able to get done in a very challenging environment. If you're losing soft monies, equity pricing may be slightly, depressed. These types of features and opportunities are how the difference between deals getting done or not. There's a couple questions on recycle bonds, I think, and let me know if I miss any. One is, does every state recycle bonds? On a federal level, every state could recycle bonds, but I will say that very few states are actually doing a program themselves. But there's good news. You don't need the state to do a program. You need to be a developer that is proactive and understands the benefits of recycle bonds. And then you reach out to folks like us or Britton or others. We can actually track down, for the most part, recycle bonds that you can use. We have billions of dollars out there that we know are coming due each year. In fact, there's probably over $7 billion each year coming due in each nationwide. So you would be able to track down those bonds. And although there is a little bit of complexity in making sure they line up, we have many options to try to get them into your deal and provide this tax exempt benefit. You cannot cross state lines. It's a good question. So you can use recycled bonds within a state. They can move between issuers typically. Texas, they're working on some state legislation to confirm that, but you can have them move within issuers in the state. So like Virginia, Tennessee, other places, we're doing that. California does it quite a bit. But you know, most issuers are going to be excited if they can, you know, use recycle bonds. For them, it's just revenue streams. Developers are getting better interest rates. And that being said, we can skip over this, Allison, but we are creating a platform that will allow developers to find recycle bonds around the country and try to get them allocated to their transaction. I don't know we'll have much time to cover the popular structure, Britt.
Yeah.
But
Say this actually plays into one of the questions that we received. Does positive ARB have any rules around it? Does it have to be rebated to the IRS, or if it's short? Yeah.
And I'll give this over back to Britton because he used a great term of positive earnings, not positive arbitrage. I'll just say positive arbitrage implies it does have to go back. If it's earnings, then it's subject to determination based on whether there's a yield blending opportunity. We just did a deal with Britton's team, and the developer was able to generate with the structure and retain 3 million. It was a big deal, but it was over $3 million of positive earnings that were able to be used as a source in the transaction. So there's definitely ways to structure these as another benefit source. So now, again, you've heard 266 election can help with the cash flow structure, the positive earnings that Britton went over. And if you can get recycled bonds, all that interest is basis eligible and can give you a lower all-in mortgage rate. So Britton can go and sell your full deal tax exempt and not have to do a bifurcated taxable tax exempt structure.
And I think the only thing I'll add there, Kent, is a lot of good news. This is the time where the equity person brings you a little bit of bad news. Positive earnings or income that goes to the partnership does have a negative hit to our math yield. So it tends to be deemed as income to the partnership, and that has to go through our model. And generally speaking, income to the partnership is actually a bad thing when it comes to our yield, meaning pricing may drop. Because if I had the same exact deal, one that has positive earnings and income and one that doesn't, we're going to take a negative yield hit in terms of the return that we are getting, because we have to take into account the income to the partnership. So 99 times out of 100, it is still worth doing because that earnings, that income is still so much larger than the pricing difference. But it is something, again, you want all these parties talking, running numbers, and getting a sense of, okay, if the rates are at X and Y today, generally we think the interest income will be, you know, F, and we think the overall growth is X. So it makes sense. But you want to have those conversations a couple different times because rates move.
Yeah, and yeah, I think you nailed it. I mean, we talk about this all the time in an effort to, again, make things run as smoothly as possible, knowing going in that there is an income hit. And so obviously no one's in the business, you know, to lose money. So, you know, we want to make sure that when we're looking at that, that we're providing you, your equity provider, with what this looks like today. Obviously we can't, you know, predict what's going to happen in the future, but certainly want to have those conversations up front so that everyone's on the same page. So at the end of it, we're not scrambling to try to figure out what to do with this and how best to handle it. So appreciate that as well.
Yeah, agreed. I know we're running out of time here, but at the end of the day, there is some distinction. And like I said, we are working with Novogradac and Stiefel on ways to either reduce or completely eliminate the negative impacts of income. Sometimes it can go to the GP. And then there's actually, if there's a source available like this positive earnings, they can be actually used a portion of those to pay any tax liability, and especially if it goes to a corporate tax payer. So.
Yeah, the slides will be available with the beautiful animation that I just skimmed through. But kind of going back to the benefits and to Kat's earlier point of, you know, soft fundings or funds are drying up or are unpredictable, and so finding these bond solutions, taking these 266 elections, things that you can kind of create into the foundation of your structure that's gonna add benefit to the deal is going to be more of a sure thing moving into the next year. So again, under this cashback forward structure, being able to generate additional equity through that 266 election. And, you know, this is a net savings, even given the additional costs of moving from, say, a private placement to this cashback forward structure, with the additional costs of the rating and underwriter's fee and some of the other things that come along with that. Your net on this example of a $30 million deal is generating over $1 million. So that's a lot of grant funds that you would have to run around and chase. So like being able to build this into your structure is a tremendous benefit. So this is just sort of the math behind a concept that Kent mentioned earlier, the idea of the bond earnings being able to be used in your numerator on your 50% test. So again, this will be a reference within the slides for folks to be able to reach out with questions if they have them, and some of the other benefits as we're looking at sort of market conditions where construction loan pricing is higher than it has been. Being able to sort of delay the draws on that and using other funds that may be cheaper to come in and serve as collateral can also generate some savings.
And then the 25% test, you know, when that's effective, that'll really be a big factor for deals that have maybe a lot of soft dollars. I think the leveraging those cheaper dollars are going to be really important.
Well, here we are. Our contact information is also included in the slides, and really appreciate any questions that folks may have. You know, Tiber Hudson, we do offer free bond trainings if developers want to set up those opportunities. We're happy to schedule that. But look forward to seeing everyone next year at the National WAHN Summit. And yeah, really appreciate all the interest today on bonds. And again, any questions, please don't hesitate to reach out. Thanks very much to the panelists today.
Yeah, thank y'all.
Thanks.
Great presentation. Thank you all so much.